Hi everyone, a very good afternoon to all of you guys. Welcome to the part 1 of the numerical practice series related to your SIDBI exam. Okay, so what we'll be doing here is we'll be practicing a lot of numerical questions related to your SIDBI exam, right? So these sessions will be completely focused on numerical practice and concept practice related to your important questions for your examination. So in today's session, I'm going to discuss a lot of the questions from the topic financial ratios. Okay, from the financial ratios. And in the coming next two sessions, what I'll be doing is I'll be picking the numerical topics from each and every part of your syllabus, right? So let's quickly start the discussion, right? The very first question, and the question which is a most favorite question of SIDBI, because mostly they are asking questions around the liquidity ratios, right? So what liquidity ratio is all about? It is all about the it is all about the short-term solvency, right? What do you mean by liquidity ratio? How much short-term assets we are having to pay off the short-term liabilities, right? To pay off the short-term liabilities. So here we are having a format of balance sheet. We need to calculate the current ratio here, right? Acha, can anyone tell me the formula of current ratio? Very simple one. What is the formula of current ratio, guys? The formula to calculate the current ratio is current asset divided by current liabilities. Now, what are my current assets? Those assets that I'll be realizing within 1 year, right? I'll be getting benefit from these assets within 1 year, and current liabilities means those obligations that I need to pay within 1 year, right? Current liabilities. So here in the asset side, I can see building, that's a non-current asset, plant and machinery, that's a non-current asset, land, that's a non-current asset. So I don't need these three elements. Stock is a current asset. Losses written off, this is a fake asset, fictitious asset. That's a fictitious assets, it's a fake assets. Debtors, it's a current asset. Cash, it's a current asset. Preliminary expense again is a fictitious asset, right? So fictitious assets are neither non-current asset or nor the current assets. Okay, so please do remember, we don't consider the fictitious assets in the calculation, right? Ever. So guys, what will be my current asset? Stock 4,20,000. Debtors 3,40,000. Cash 24,000. That's the total of my current asset. What will be the total of my current liability? Now in the liability side, we can see that short-term borrowing, that's a current liability, right? That's a current liability. Bank overdraft, that's a current liability. Trade creditors, that's a current liability, because these obligations I need to settle within 1 year. Within 1 year, I need to settle these obligations. Debentures, it's a non-current liability. P&L account, general reserve, they are part of equity shareholders fund. Loan from bank, that's a non-current liability. Preference and equity are capital. So I can say that these three things will sum up to be my current liability, right? So 2 lakh plus 1,20,000 plus 30,000, right? So what will be the total here, guys? 4,20,000 plus 3,40,000 plus 24,000, which is 7,84,000, divided by my current liability, which is 2 lakh plus 1,20,000 plus 30,000, right? 3,50,000. What will be the current ratio here? What will be the current ratio here, guys? 2.24 times. 2.24 times, right? So 2.24 times, option C is the correct choice. Now, what is the meaning of this 2.24? If I do have 1 rupee worth of current liability, I do have 2.24 times the current assets to settle those current liabilities. That means I'm in a good position, right? I'm in a good position. I can easily settle my liabilities here, right? Easy. Next is quick ratio. Now, do you guys remember what is quick ratio? What things I need to exclude from the current assets in order to arrive at the quick assets? Any idea about that? Anyone? Anyone, guys? Can I say, if I exclude stock, prepaid expense, and advance tax, right? Stock, prepaid expense, and advance tax from my current asset, then I'll arrive at my quick asset. So, stock, prepaid expense, and advance tax, these three things are not at all my quick assets, right? So, stock, it's a current asset, but it is not a quick asset. Debtors, it is a current asset as well as it is a quick asset. Cash, it is a current asset as well as a quick asset, right? Because I cannot forcefully sell my stock to someone. That's why it's not at all my quick asset. So my quick assets here will be 3,40,000 plus 24,000, right? So what is the formula to calculate quick ratio? Quick assets divided by current liabilities. So current liability will be the same only that we just computed. 2 lakh plus 1.2 lakh plus 30,000, right? So 2 lakh plus 1 lakh 20,000 plus 30,000, how much it is? 3 lakh 50,000. And what is the numerator? 3 lakh 40,000 plus 24,000. 3 lakh 64,000. What will be the ratio here? 1.04 times is the answer. That means if I do have the current liabilities of 1 rupee, I do have quick assets of 1.04 times, right? So at least I can use my quick assets to settle my current liabilities is what the meaning is, right? So current assets minus advance tax minus prepaid expense minus stock will be always the quick assets. This is the first approach, or you can directly pick the quick assets from the balance sheet, which I did, right? To save time. And do remember, prepaid expense is completely different from preliminary expense, right? Prepaid expense is completely different from preliminary expense. Preliminary expenses are fake assets, fictitious assets. Prepaid expense are actually current asset, but they are not quick asset, right? So if I draw a chart, preliminary expense, they are not at all current asset. They are also not the quick assets. They are fake assets, fictitious asset. The real meaning is fictitious assets. If I talk about prepaid expense, which is not there in the question as of now, prepaid expense, if I have paid my rent in advance, that's a prepaid expense. That's an asset for me. Because in the near future, I don't have to pay the money again, right? So it's a future economic benefit. So it is a current asset, but it is not at all a quick asset, right? Next one. Calculate the cash ratio from the following information. So here we need to calculate the cash ratio, right? We need to calculate the cash ratio here. Now, what is the formula to calculate the cash ratio? Cash and cash equivalents divided by current liability. So we all know the current liability. This is my current liability, right? 3,50,000 is my current liability. Cash and cash equivalents. Here is my cash, 24,000 is my cash and cash equivalent. So 24,000 divided by 3,50,000, which is 0.0685 something. So it is nothing but 0.07 rounded off, right? Option C will be the correct choice. Option C here will be the correct choice, right? Now in the next question, what we need to do is we need to calculate the return on asset. Return on asset. Now, if you guys don't remember the formula, we can easily ascertain the formula even if you don't know it. Return on asset, that means return is on asset. Return is on asset. The return is on asset. That's the formula, right? That's the formula. Now, what is the meaning of return here? The meaning of return here is nothing but profit after tax divided by my assets. Now we can read the question. We are having sales, cost of goods sold, so we can ascertain our gross profit. Then we do have operating expenses, interest expenses, so EBIT, EBT, everything we can calculate, right? Tax expenses also there, so earning after tax, that is profit after tax, is also we can easily compute here, right? And we do have average assets as well. So can I say that one aspect is already sorted? They have given me the average assets, so my denominator is already sorted. I just need to calculate the profit after tax, right? I just need to calculate the profit after tax. Now, how to calculate profit after tax? Can any one of you compute this? Try giving it a shot and let me know your answer. Then I'll be doing it. Okay, so I'm giving you 1 minute. Try to calculate the profit after tax here, everyone. Okay, guys. So let's try this question. Okay, what I need to do is I need to calculate the profit after tax, right? What things do I have in question? They have given me sales of 3 lakhs. So let's start writing sales of 3 lakhs. Then cost of goods sold of 1,40,000. So this will be my gross profit, right? What will be my gross profit? 3 lakh minus 1,40,000. So 1,60,000 is my gross profit, right? Then I do have operating expenses. Operating expenses 30,000. So let's deduct the operating expenses as well. So I'll be having a EBITDA margin of 1,30,000. Do we have depreciation and amortization in the question? No, we don't have depreciation and amortization in the question. So what we can do here is, we can take 0 here, and your EBIT will also be 1,30,000 only. 1,30,000 only, right? Your EBIT will also be 1,30,000 only. Then they have given us the interest expense, 10,000, right? 10,000 is my interest expense. So what will be the EBT? 1,20,000. What is the tax rate? They have given us the tax rate of 20%. So I need to charge 20% as taxation. What will be my earning after tax? 1,20,000 minus 20%, right? 96,000 will be my earnings after tax. And that's what I need to solve this particular question. That's what I need to solve this particular question. So 96,000 divided by 10 lakhs multiplied by 100, right? So what will be my return on asset? It will be 9.6%, right? Option C is the correct choice here. 9.6% is the correct choice here, right? 9.6%. Now in the next question, ABC Limited has purchases during the year of 2 lakh rupees. So purchases is given 2 lakh rupees. The balance sheet is showing an average accounts payable. Average accounts payable. Now what is accounts payable? It is nothing but my creditors. It is nothing but my creditors, right? So they have directly given you average accounts payable of 15,000. You do have total purchases, which is 2 lakhs. Average accounts payable 15,000. So I think both the parts are sorted. Both the aspects are sorted here. You need to calculate the ABC's payable period. Now what is payable period? It is 365 days divided by your payable turnover ratio or your creditor turnover ratio, right? I don't know my payable turnover ratio. We can calculate it. We can calculate it. They have given you the purchases. They have given me the average accounts payable as well. So what is payable turnover ratio? Credit purchases 2 lakh divided by average accounts payable 15,000. If they haven't given you the average accounts payable, they must have given you the opening creditors and closing creditors. So how do you compute it? Opening creditors plus your closing creditors divided by 2, that's average, right? Simple average. So 2 lakhs divided by 15,000, this will give me 13.33. 13.33 times. This is my payable turnover ratio. You just need to equate it, right? You just need to equate it here. So 365 days divided by 13.33 times. 365 divided by 13.33 times. 28 days will be your correct answer, right? So ideally you should be having 27 days here in the options. However, we are having 28 days. So that's fine. We can go ahead with the option B, 28 days. Now for those who think, sir, you need to take only the credit purchases while calculating the payable turnover ratio. However, you have taken the total purchases here. I don't have any option because they haven't given me a bifurcation of how much is my cash purchase, how much is my credit purchase. So I need to assume here that whatever purchases they have given me is nothing but the credit purchase. Any queries, guys, in this? It's a simple one. We have practiced in the normal sessions as well. Next is your inventory turnover ratio. Now, what is the formula to calculate inventory turnover ratio? Anyone? Any idea about the formula to calculate your inventory turnover ratio? How quickly you are able to turn your inventory, right? Is the meaning of inventory turnover ratio. How quickly you are able to turn the inventory. What is the formula? Anyone? The formula is cost of goods sold divided by average inventory. Cost of goods sold divided by the average inventory, right? That's the formula. So here in the question, they have given me the gross profit ratio of 2%, credit sales and cash sales. So this will be my total sales, 12 lakhs. So from these two things, I can calculate my cost of the goods sold, right? My total sales minus my gross profit will be my cost of the goods sold. That's what we can see here in this particular chart as well. My total sales minus my gross profit will give me the cost of the goods sold. Another methodology is cost of goods sold is equal to opening stock plus purchases during the year plus any kind of direct expense minus the closing stock. This is also the second method of computing the closing cost of the goods sold. This is the first method, right? Both is very, very useful in your examination. So total sales I am having, I can easily compute the cost of the goods sold. Do I have average inventory? No, but I have closing and opening inventory. So what is average inventory? Opening stock plus closing stock divided by 2. So 12,000 divided by 48,000 divided by 2. So 60,000 divided by 2, that means my average inventory is nothing but 30,000 here. My average inventory is 30,000, right? I just need to calculate my cost of the goods sold. So sales is 12 lakhs. We need to take both the sales credit as well as the cash sales, because we are calculating the inventory turnover ratio. Now inventory can turn in cash sales as well as in debtors, which is nothing but credit sales. That's why we consider both the aspects here, right? Sales minus your GP ratio, 2%. This will be my cost of the goods sold, right? So 12 lakhs minus 2%, that gives me 11,76,000. 11,76,000 my cost of the goods sold divided by my average inventory, which is 30,000. This will give me 39.2 times. Option A is correct. Option A is correct here. Any queries, anyone? Any queries in this? So we'll be doing a lot of questions on the financial ratios today. Rest of the topics we'll be also doing in the coming 2 classes. I'll be taking numerical questions from each and every area here from your syllabus. Any queries in this, anyone? Okay, perfect. The next question here is, we need to calculate the average age of the inventory. Now, what is average age of the inventory? That means days of inventory in hand. For how many days I need to keep my inventory in my business, right? Before it turns into sales. For how many days I need to keep my inventory with me before it turns into the actual sales. That's what the days of inventory in hand or average age of inventory is all about, right? So how to calculate it? They have given us that we need to take 360 days only in a year. So we need to specifically take 360 days. Otherwise, we always take 365 days, right? Divided by my inventory turnover ratio. Now, inventory turnover ratio I have already computed 39.2 times. So 360 divided by 39.2 times. 360 divided by 39.2 times. It will be 9.18 days. So here the correct choice will be option D. Option D here will be the correct choice, right? Next one. A company's working capital is 20 lakh rupees. So what do you mean by working capital, guys? Current asset minus current liability is my working capital, right? Acha, the very first thing that you need to know about working capital before let's do this question after 5 minutes, 2 to 5 minutes. First, let's understand the concept of working capital here. There are two types of working capital: gross working capital, net working capital. Can you tell me the difference, guys? Anyone? Can anyone tell me the difference here? Can you guys tell me the difference here? Net working capital is nothing but your current asset minus current liabilities. That's what your net working capital is all about, right? Your gross working capital is nothing but total of current assets. Total of current assets is your gross working capital. Your net working capital means current asset minus current liabilities, right? So only if working capital is given in any question, you need to assume that it is asking you net working capital only. So by default, we call working capital as current asset minus current liability until and unless they are specifically stating the gross working capital. In gross working capital, if they write clearly gross working capital, then you need to assume it is total of all the current assets, right? Let's solve this question. A company's working capital is 20 lakhs. The annual sales is 120 lakhs. So my sales is 120 lakhs and my working capital is 20 lakhs. What will be my working capital turnover ratio? One of the most simple question, right? One of the simplest question from ratio analysis. So can anyone tell me what should be the correct answer here, guys? Working capital turnover ratio. We know that in the turnover ratios in the numerator, we always have net sales or the net turnover or the net revenue, right? My revenue from operations divided by my working capital. That's it. So 120 divided by 20. The answer will be 6 times. Option B. So what it states is, I do have a working capital requirement of 20 lakhs in order to generate a sale of 120 lakhs. Right? So 6 times will be my working capital turnover ratio. 6 times will be my working capital turnover ratio. That's it. Any queries in this, guys? Anyone? Any queries? Any queries here? Or all clear? Okay, guys. Next question. Here we need to calculate the interest coverage ratio. How much profits we are having in order to cover the interest obligation. That's what the meaning of interest coverage ratio is. How much profits we have to cover the interest obligation. So in the question we are having net profit after tax. This is nothing but PAT or EAT, right? Profit after tax or earning after tax. Then they have given us the tax rate as well. Long-term debt at the rate 10% interest. So we have taken a loan of 15 lakhs, that to a 10% rate of interest, right? So what do you think is the formula of interest coverage ratio? Anyone? What is the formula, guys, of interest coverage ratio? It is EBIT, earning before interest and tax, divided by the interest, right? Divided by the interest. Now, do we have EBIT? No, we don't have EBIT. We have profit after tax, right? Here we are having profit after tax. So let's calculate the EBIT first. Let's calculate the EBIT first. So we are having profit after tax or earning after tax, right? How much? 1,20,000. 1,20,000. So profit after tax 1,20,000. Right? I need EBIT, earning before interest and tax. I need EBIT here. So I need to go backward. I need to do a backward calculation here. Right? So let's do it. Tax rate is 50%. So 50% must have been already deducted in order to compute this 1,20,000. Long-term debt is 15 lakh rupees, where I need to pay 10% interest. So can I say that 15 lakh rupees is the loan amount on which I need to pay 10% interest? So my interest will be 1,50,000. Right? So if I go backward, my earning after tax is after reducing the taxation liability, which is 50%. So can I say that my earning before tax was 2,40,000, right? So from 2,40,000, if I pay 50% tax, I'll be having 1,20,000, which is earning after tax, right? Which is earning after tax. Then I must have paid the interest as well. Again, if I go backward, 2,40,000 was my EBT, earning before tax. I need to add my interest obligation as well in order to calculate the EBIT. So 3,90,000 is my EBIT. 3,90,000 is my EBIT, right? So here I am having 3,90,000 as my EBIT. What is my interest amount? It is 1,50,000. 15 lakh pe 10%, 1,50,000. So can I say that my interest coverage ratio is nothing but 2.6 times? Option E. Now, what is the meaning of this interest coverage ratio? That means if I have to pay 1,50,000 as interest, I do have 2.6 times more profit. So I'm in a very comfortable position. If the interest amount is 1 rupee that I need to settle, I have 2.6 rupee in my pocket as profit element. Right? In my pocket, I'm having 2.6 rupees and I just have to pay an interest obligation of 1 rupee. So that's what interest coverage ratio is all about. Right? And I hope it's clear. Any queries in this? Anyone? Any queries? Any doubts? Any queries in this, guys? Anyone? Or all clear? Now here we are having net profit 10,000 rupees. So they have given me the net profit of 10,000 rupees, the cost of goods sold 80,000 rupees, gross profit of 15,000 rupee, and I need to calculate the net profit margin ratio. Now what is net profit margin ratio? Whatever my net profit is divided by my sales, net sales into 100, right? That's what the formula of net profit margin ratio is all about, right? So my numerator is already sorted. I do have my net profit of 10,000. Do I have sales in the question? No, I don't have sales in the question. Now, can you guys tell me how to calculate sales in this particular question? How to calculate sales here in this particular question? How should I approach sales? Any idea, anyone? So guys, how do we calculate sales? We do have gross profit and cost of the goods sold. So it is nothing but COGS plus your GP. That's your sales only, right? So my COGS, cost of the goods sold, is 80,000 plus my gross profit is 15,000. So can I say that 10,000 divided by 95,000 into 100? 10,000 divided by 95,000 into 100, right? So 10.53% will be my net profit ratio here. Okay, I hope it's fine. So we have done a lot of variety, plus we will be doing some more questions as well in today's class, plus in the coming class as well. We'll be taking each and every topic from your syllabus and we'll be thoroughly practicing all the questions, right? So guys, next one is your asset turnover ratio. Asset turnover ratio. What is the formula to calculate asset turnover ratio? In turnover ratios, guys, in turnover ratios, what is the formula? Net sales divided by your assets. So here in the question, they have given us the net profit margin of 5%. They have also given us the total assets. So can I say that one aspect is sorted? I already have assets 8 lakhs. I just need total net sales, right? Return on asset, they have given 8%, and I need to calculate the asset turnover ratio. So what happens is in these kind of questions, what you need to do is they have given you a relationship. You can definitely calculate the sales here, but via a relationship. You need to use a relationship in order to calculate it. So can anyone tell me how to calculate this? Any idea, guys? So look, what they have given in the question is net profit ratio, which is 5%. Now what is net profit ratio? It is nothing but net profit divided by sales into 100, right? So that is 5%. That is 5%, right? However, the problem is here we don't know what net profit is. We don't know what sales is. We only know the net profit ratio, so that won't be as of now much useful. Second portion, they have given us the return on asset, ROA, return on asset, which is 8%. So what is return on asset, guys? Return on asset means profit after tax divided by my assets. That's what return on asset is, right? How much return I'm able to generate by using the assets. And here I know my asset amount, which is 8 lakhs. So can I say that my profit after tax will be 8 lakh multiplied by 8% here, which is 64,000. Now I know my profit after tax or the net profit. So if I equate this here, now I also know my sales, right? 64,000 divided by 5%. So my sales is 12 lakh 80,000 here. 12 lakh 80,000 here. So what will be my asset turnover ratio? It will be 1.6 times. It will be 1.6 times. Option C here is the correct choice. Option C here is the correct choice. So this is a complex question, right? Which requires analytical skills, or I can say more, it's more of a quant related question mixed with the financial ratios concept, right? Now we need to calculate the proprietary ratio from the following information, right? So I'm giving you 1.5 minutes. Just try to give it a short 1 to 1.5 minutes. Just try to calculate the proprietary ratio. Then I'll be discussing it. Acha, for those who don't know the formula of proprietary ratio, proprietary funds or the shareholders funds divided by the total assets, right? Shareholders funds divided by the total assets. That's what the formula of proprietary ratio is. So any idea, guys, here? The first thing here is shareholders fund, right? Shareholders fund. So can I say that my equity share capital, my preference share capital, my general reserve, my profit and loss account, that's my shareholders fund. That's my shareholders fund, right? Debentures is a non-current liability. Creditors, bank OD, short-term borrowings, that's a current liability. Loan from bank is a non-current liability. So this will be my shareholders fund, right? As of now, this will be my shareholders fund. And what is my total assets? That's very simple. This is my total assets, right? However, things are not so simple here. Why? Because in the asset side, you can see that we are having two fictitious assets, two fake assets we are having. Two fictitious assets we are having in the asset column. Now we need to write it off from the total asset because that is not at all an asset. That's a fake asset. That's why we call it as fictitious assets. So we cannot take it in the total assets. We need to subtract it from the total assets. However, once I subtract it from the total asset, my balance sheet will be imbalanced. There will be an imbalance in my balance sheet. Why? Because I'm just subtracting it from the total assets. And in accounting, we always give two impact of each and everything. That's why we call it as dual aspect, right? That's why we call it as double entry bookkeeping, right? So definitely I need to reduce my total assets. Simultaneously, I need to reduce my reserves and surplus as well, because from that only I'll be charging my fictitious assets. If I want to write it down, if I just want to write it off from my books of accounts, what I can do is I can use my reserves and surplus to write it off. So how to calculate? My shareholders fund. My shareholders fund here will be my equity share capital, 8 lakhs. Plus preference share capital, 4 lakh. Plus reserves and surplus, 1,50,000. Plus P&L account, 76,000. Right? Minus my fake assets. Preliminary expense 15,000. Minus losses written off 27,000. This will be my shareholders fund. What will be my total asset? Total asset they have mentioned 23,76,000 minus my preliminary expense 15,000 because that's a fake asset. That's a fake asset, right? That's not at all a real asset. It's a fictitious asset minus losses not written off 27,000. So this will be my total asset, right? So ideally my answer here will be 13,84,000 divided by 23,34,000. So the answer here will be 0.59 times. 0.59 times. And I hope it's fine. I hope you all are able to understand this one. Right? Then we have the concept of net working capital. Now, what is net working capital? It is nothing but current asset minus current liability. If they ask you working capital, then also current asset minus current liability. If they ask you net working capital, then also it will be current asset minus current liability only. However, if they ask you gross working capital, then it will be total of all the current assets. Total of all the current assets, right? So here I am having the format of my balance sheet. I just need to identify the current asset. Stock is my current asset. Debtor is my current asset. Cash is my current asset. Preliminary expense, fake asset. Losses not written off, fake assets. Land, non-current asset. Plant and machinery, non-current asset. Building, non-current asset. We have already discussed this in the current ratio, right? So these will be my current assets that I can total, right? So 4.2 lakh plus 3.4 lakh plus 24,000. This will be my current asset. What will be my current liability here? Short-term borrowings, current liability. Bank overdraft, current liability. Trade creditor, current liability. Why? Because I need to settle these obligations within 1 year. Within 1 year, I need to settle these obligations. So these will be my current liabilities. 2 lakh plus 1,20,000 plus 30,000. Debentures, non-current liability, P&L account, it's a part of my equity shareholders funds. General reserve, same as P&L. Loan from bank, non-current liability, preference is my capital, equity is my capital. So straight shot, 7,84,000, which is the total of all the current assets, minus 3,50,000, which is the total of all the current liabilities. So 4,34,000 is my net working capital here, right? Next one, capital gearing ratio, will be a homework for you guys. So as of now, just give it a shot, try to answer this particular question, and in the next session, I'll be solving this again for you. We'll be practicing some more questions related to ratio analysis and rest of the part of your syllabus as well. So I'll be covering different other chapters as well, from which you can get a question in the examination. Okay, guys? So please do practice it, and tomorrow we'll be discussing different chapters as well. Okay, so thank you so much. Bye bye. Take care. Best wishes.